Everyone, welcome back to the Mike Rosehart Show. We're live again for another weekly installment. Apologies for the phone being frozen. I accidentally swiped over and it brought up a side screen, so I had to get back to YouTube there. So hopefully I didn't lose you guys in the first 20-30 seconds there, but we are live. So what is going on? We are in a recession. It has been major pain in pretty much every market, every country. Inflation is running rampant. Uh, BOE, Bank of England, coming out and buying all the bonds. Basically, it feels like we are deep into a recession. There's a hint or a whiff of some of the pain that is to come. Remember, the stock market is forward thinking. So the point at which we are in the middle of the recession, like in the real pain of it, the market starts to rebound because it starts to look to the future. And so when we are at the bottom, that's when it will start to spike. So just be cognizant of that. I'm currently neutral. So I'm not long, I'm not short. I've got hedges on all of my long positions. So if stocks tank down, my longs will be, my stocks that I hold long, my equity will go down, but I have short contracts that are protecting it exactly right now. So I capped any upside and any downside because I feel like there's a pretty good chance that tomorrow is a binary event of 1 or 0, or effectively it either goes all the shit tomorrow or it doesn't, depending on the CPI reading. Does it come in at expectations, or how are things going to play out with tomorrow's reading? Every time the Fed speaks, because the US is the world dominant currency, depending on how their Fed handles the current inflation crisis, that is how every other country reacts, every other stock market, every other business market. Globally speaking, the International Monetary Fund is coming out and saying, hey, we're in for some trouble. If you pretty much talk to any government official right now that isn't running for election, they will tell you that we're in for a world of pain. Now we are clinically in a recession. By definition, we've now had, I believe it's 3 quarters now of lack of growth. The international data around growth is not looking good. We might have a year of negative global growth. Many countries are in full-on hyperinflation, 20, 30, 40% inflation. First world countries experiencing 8 to 14% inflation. It's coming down. It's getting under control. It's good. But the pain is at the same time, to get there, the central banks have had to increase rates faster than they ever have had to in history. The point of January to now is the fastest rate hike increases we've seen ever in history. In a century, we've never seen rates creep up this fast, this hard, this quickly. Now, we've seen big jumps before, and in the 70s and 80s, there were jumps that continued on for years. For years, they increased rates, but it was a slower pace. It wasn't as extreme as we're seeing now, where we literally had in Canada I had a 1.249 variable rate mortgage, 5-year variable mortgage. It now currently sits at 4.7 or something, I think. So it's 300% more expensive than it was. That's a big shock for most people who are on variable rate products. But to go from the cash flow you had at 1.25% 5-year variable was unreal. And now the cash flow on a variable rate product at 5%, 6%, 7%, we're talking about potentially even 8% interest, is wild. So I definitely recommend, I did recommend up until these next rate hikes coming up, I think it's smart to do a 2-year fixed mortgage. If you can get a 2-year fixed, you can break it early at 1.5 years with no penalty. Here in Canada, you should lock up a 2-year fixed mortgage. I think that's the safest way to go. In 2 years, I'm hopeful, and I believe that rates will come back down because we will have been put into a deep enough recession that people will cry, please help. The government will cry, please help. Everyone will basically be in major pain. And when we're in major pain, that's when rates come back down, right? Major pain will result in a lack of demand. People will stop buying, inflate. Basically, businesses will be forced to drop prices. Supply and demand imbalances will balance, and we will then have a full-on recession because prices are falling at the same time as wages start falling. Everything will be falling. The markets are already preemptively falling, but things will continue to drift further downward. I think we've seen in the real estate sector in Canada anyway, in Ontario specifically, we've seen a 30% pullback from the peaks in February. And so I think there might be more to come, but I think our downside is limited to another 10 to 15% of downside maximum. Whereas there is a 30 to 40% upside of real estate. So I'm starting to become bullish on real estate again. We're at 1% real properties are starting to pop up, right? And I'm seeing that being interesting. I'm seeing that being something that, there's this latent effect, right? This latent wealth effect. When you absorb, or sorry, wipe out 1/3 of all global wealth, I think we're more than a third now, about a third. If you include all the crypto, all the real estate, and just like the Nasdaq is down 35% or 37% from all-time highs. A lot of tech stocks like Facebook are down 65% from all-time highs. Like 2/3 of Mark Zuckerberg's net worth is wiped out. We're talking multiple trillions of wealth is gone. The effects of that take time to trickle down into the economy. The eventual layoffs, the eventual pain hits the rest of society. It takes time, it lags. When you raise interest rates, real estate takes time and lags as well. We're starting to see the effects of that as well. And I think that it's interesting though, we're seeing that real estate is kind of holding flat at a certain point. I think at a certain value, given the cost of supplies to build and the scarcity of land, there's a certain bottom, certain stickiness to real estate where some tech companies don't have that. If a tech company isn't producing and you can't raise capital in this type of market, because bonds, by the way, bonds have had the worst performing year in over a century. If your portfolio and I screamed it from the mountaintops last year, all of last year, I think like 10 different, I stream every week. So I did 52-hour live streams. Some of my streams were an hour and a half. So I probably did 60 hours of live streaming on my weekly streams, 60 episodes last year. And I think on like at least a third of my episodes, I was like, someone brought up a question in my live stream. It was like, hey, what do you think of I went to my financial advisor. They're like, hey, 60-40 bonds and equities. What do you think? Like anyone who's over 50 is pretty much in like a 50-50 bonds, equities. They almost always put people in fixed income and bonds. I was like, why would you fix in at 1 or 2%? We're at historically the lowest point in history. You want as much debt as possible. You don't want to be lending, basically locking yourself into GICs at 1 and 2% interest. So I was adamant that you should be 100% equities. And I stand by that today. However, for the first time in history, because bond markets have been destroyed now, think about this, right? If you had a bond at 2%, if you wanted to go sell that bond right now, the bond market might be paying 8% yield on those bonds. And let's say it's a 3-year bond, you have to cover the difference between what your rate was, say it was a 2% bond, to sell your bond in the open market and get your face value back. You're going to have to compensate for market rates. So if market rates are 8% and your bond is locked in at 2%, you don't have to sell your bond for a 6% loss per year times 3 years is an 18% loss. That's huge. With an upside of 1 to 2% a year and a downside of 18%, that was an insane risk to reward trade-off. I don't know why any financial advisor was putting their clients into those types of products. There were much better places to park your money. The bond market is just being destroyed. But for the first time in history, to circle back to the tech discussion, tech companies, growth companies, anyone trying to raise money right now, even for real estate, they're trying to raise money against US Treasury type products at 7 and 8%. How do you raise money when the government is paying, it can't even raise money at 7%? How do you think tech is going to be able to raise money at 10%? When tech is way more risky, some startup tech company, what chance do they have, right? I like that. Someone just brought up whole life insurance. I'm going to bring it up because it's on the topic of interest rates. For the first time as well, there are whole life insurance products and universal life insurance products that can make sense. I don't like whole life insurance. However, if you structure it properly, there are ways to get a whole life insurance type product wherein you buy a term insurance built into the product and you are able to do paid up additions where you're able to contribute additional extra amounts on top of the insurance portion. So say your premiums were $10,000 a year, you'd pay $2,000 in fixed premiums for the insurance portion for a 10-year period, and $8,000 of it would go right to, the principal building account. And within that policy, it can grow tax-free. It has a stop loss. I mean, it can't go below 0 unless the company goes bankrupt. So if you believe Scotiabank will go bankrupt, if you believe Great-West Life could go bankrupt, there is some risk there. They are partially insured as well by other companies and by the government. I think it's a pretty much 0 risk, but anyway, they would pitch it as a near 0 risk. There's always a risk to everything. However, those policies have never returned 0. So in markets like now, where the S&P is down 25%, those policies have returned in some cases 2, 3, 4%, because a lot of them are in type fixed incomes, real estate stuff that's just paying a consistent type of return. And they have insurance to protect against downside in those insurance type products. All of the equity investments that they've taken inside of that policy, that by the way is growing tax-free, that's the benefit of it, by the way. So the question is the tax shield that you're getting from the whole life policy greater than the cost of insurance to have that policy set up? Because I don't believe having insurance is valuable. I believe in self-insurance. However, if the cost of insurance was $2,000 a year and the tax shield on that was $3,000 a year, you'd be at a net gain. On top of that, the really cool thing with insurance is that you can lever it up. You can take it to the bank and you can borrow 80% loan to value against that policy. And it can be tax deductible. If you go and take that capital you pulled out of the policy, you put $10,000 in your insurance policy, it grows tax-free, turns into $20,000. You borrow $16,000 back out of that. So that's more than you put into it, all withdrawn tax-free. And now the interest on that new $16,000 you've pulled out of your whole life, or I guess it's not really a whole, I don't like whole life specifically. There's a type of whole life product wherein you couple term insurance with it and do paid up additions to get the amount of insurance you're paying down. So the annual premium you're paying, majority of it is going to principal in year 1, year 2, year 3. Typically with a normal whole life insurance product, in year 1, the majority of your entire premium is going to the agent who sold you the insurance, and they are getting a big fat check. Typically equal, when I was licensed, I was getting around 85% of your first year's annual premiums. So you paid $10,000 in whole life insurance premiums. As an agent who sold it, I would get $8,500. That's not a good deal for you because it's 100% loss on your first year's principal. Now you need a lot of years of growth after that, tax-free, to make up for that. And over a 20, 30-year period, it can kick ass. You just got to be very careful because a lot of the products they sell have really shitty insurance side premiums baked in. And so the actual cash surrender value and the investment account is much less than you've contributed. And so in the initial years, there's a huge loss there in paying the fees to the advisors and the fees in there to the, to the companies that support it for the premiums for the insurance and the off chance that you die. That's why I recommend a product that is designed to ensure you the term portion in the first few years that really give you a high cash value in the first year. So when you get someone to write this up for you, ask for really high cash value in your first 5 to 10 years. It is a good product to have. If you plan to stay in Canada, you don't want to go to a tax-free nation, you're planning to stay here and pay tax in Canada and not leave Canada and build your wealth up in Canada, it can be a great way to pass wealth on between generations in a tax-free manner. It can be a great way to grow your wealth as a tax shield. If you're in the top marginal bracket and you plan to stay there for your entire life, including in retirement, it can be a cool tool to have. Be careful because most of the banks and private banking are selling you on the fees they're making. So they're setting up products that aren't necessarily the best for you. I currently have a life insurance policy. I pay $1,000 a month for it, I think. And I got set up into one it was a cool product. At the time, it actually had a really good, it was a pay 20 that you only need to pay 10. So I only have to pay for 10 years and then it's done. But it's priced like a pay 20. So there's a glitch in their system. I lucked out in the fact that there was an actuarial error. They honored it. Even with the actuarial error that made it like 30% cheaper than it should have been, it still isn't that great net of all the fees. It'll take me like 15 years. And if I leave to a tax-free nation, I lose to that benefit. So again, I have some products that are doing really well. It's growing tax-free in over 10 or 15 years. It can make sense. You've got to run that against a tax-free savings account or against an open account. Your max tax bracket on a capital gain, like if you're just holding the stock market, is like 24, 25% tax because capital gains tax, half of it is capital gains tax-free, half of it is taxed at your marginal bracket. So when they run these simulations, all these whole life insurance advisors, they're running it always at like your tax shield is like worth 53% because you're saving 53% tax. And it's like, are you saving 50% tax? On equity investments, they're considered capital gains if they're passive in nature and long-term holdings. You're really paying maximum half of your marginal tax bracket. So the real tax shield's at 25%, not 50. And most of the financial advisors are running this tax shield at 50%. It's not 50%. So that's something to think about, is that they overstate the tax benefits and they understate how important those first 2-3 years of loss are. Now, there are some really cool products in the private banking space where they will use your entire net worth and all of your income, and they will give you an unsecured line of credit and a line against your insurance product. So you could put $1 million into a whole life product and then borrow that $1 million right back out immediately. So you've put no money in. You effectively put $1 million in, they lend you $800 back, 80% loan to value on your insurance policy. That $1 million can now grow tax-free, compounded at 6% a year forever. And then you borrow that money back. So you have no money in there. It's all borrowed money against a policy that can't have a 0 year. It can't have a negative year. It's impossible. They've set the policy up so that it gets like a 0 to 10% growth, but it's capped out at 0. So you can't go below. You can't have a loss year. That's important for compounding value, right? It's important to not lose money. That adds a lot of value, I think, to the policy over long term. So there are some cool things you can do with the policies where they'll give you 800 back and then they'll give you a $200,000 line. So your whole million you put in, you have now borrowed back from the bank. The bank has effectively subsidized the entire investment into the policy. And it makes sense for them because they're getting to make money on the interest they're lending you. They're getting to make some points on setting up that line of credit for you. And they're making money on the fees and the insurance policy. You're winning because you didn't put any money up. You put $1 million in, you took $1 million back. You have no money at all in the product. All the interest you have is now tax deductible. They charge you 5% interest rate now in this environment. You're really effectively paying 2.5%. Because you take that money, you invest in real estate, and get a full marginal tax bracket deduction, while all the investments inside the whole life policy are growing tax-free. So if you have a 6% yield on your policy and your interest rate would be 5%, you'd think, the yields aren't that strong. But after the tax shield is applied to the interest expense, you're really not paying 5% interest to the bank. You're really paying 2.5% because you're getting a tax shield back if you have other income you can use to offset that interest expense against. So there's some really cool things you can do. Most people, 95% of the agents out there are selling it wrong and not setting it up properly. So do some due diligence. There are some cool products you can use where you don't have to put any of your own money into it. That's where the whole life, it's not even whole life, it's more like a universal life, whole life term product. Talk to a few agents, get a few quotes, ask them for something that is going to maximize the cash value on year 1, 2, 3 in the early years. And they'll set you up with a policy that makes sense in the early years. That's what matters because you want your money back. If you have to crap money in your policy, that's not what you want because the opportunity cost is too large, in my opinion. Why would you want to lock in at a shitty return? I don't mind getting a 6% return if it's 6% on nothing. Like I put $1 million in, I borrowed the $1 million back. So this policy has $1 million of equity in it. Well, effectively less than $1 million in equity because there's debt against it. But the debt over time, I'm going to deduct the interest on that. And the gains inside the whole life policy are growing tax-free. So it's $1,060,000 year 2, $1,001,2 year 2, $1,013,000, $1,015,000. Eventually, over time, it'll compound positively so that there's $2, $3, $4, $5 million in that policy. You've not put any money into it because every year you contribute your premiums and you borrow them right back out. So those kinds of policies are really attractive. Be careful borrowing a policy loan because the CRA has come out and said, hey, we don't like that. It has to be a third party lender against the policy. You can't use the policy loan because that's kind of sketchy because you're borrowing against a vehicle that has no tax. So they didn't like that. So you have to go to a bank, let's say like Scotiabank or Bank of Montreal, and borrow against your policy. And then you are able to deduct the interest because you're using those funds to go invest in real estate, go invest in stocks, go invest in private mortgages, whatever. You're going to invest in something and now you can deduct that interest. So that's how you have to kind of set it up and structure it. And a lot of people don't structure it the right way. You can tell that I've done a deep dive on this. I did a project on it at Ivy a long time ago and I refreshed myself more recently. I've got maybe 40 or 50 hours, maybe 100 hours into this topic. So you might call me a small subject matter expert. I'm by no means an expert. I know enough to get by. But yeah, there you go. There's your private wealth hacking on insurance and how having insurance investments can make sense. But for 95% of the products that they sell, the majority of the policies that people send me and show me what they've got set up, it's not set up properly and they didn't do it right and they've trapped money in it. And that's what you don't want. You don't want to trap money in it. So yeah. Brian says, is your investing strategy changing given your thoughts on the recession? So yeah, Brian, I cut my losses on several positions. I cut a large portion of my Bitcoin and my Ethereum holdings. It's since dropped 20% since I cut. So I'm glad I did that. I have cash while the market continues to fall. I cut my PayPal shares, my Facebook shares. I cut a huge portion of my Amazon shares and the balance that we had there. So I cut a lot of my equity positions. It was painful. I sold my Bank of Montreal, my Enbridge, my TD. I cut almost half of my long portfolio and it was painful because I locked in a 16% loss. It was like fucking pain to lock in a 16% loss. However, I'm thankful today because most of those positions are down 30% on average. So I'd be twice as far down as I am now. So I did cut some of my long positions. I still have considerable long positions. I didn't cut all of my, I cut half my Enbridge, half my TD, half my, I cut almost all of my PayPal. I've lost faith in that company. I think they're too left-leaning and I think they're placating to the wrong crowd. And I don't like how they're treating the misinformation policies. Anyway, a number of other things. I don't like that company in general right now. I had a huge position and I cut it. However, I am all the long positions I currently hold, I hold equal short positions. So I have like a $3.5 million short on the NASDAQ right now, and it's up like 12%, which is great. It's offsetting, like it's up like $400,000 and my longs are down 500 right now or something like that. So I'm still net down, but it's basically that short. At some point, I'm going to close that short out and use that short to double down on the dip. When will that pivot point be? I don't know. Right now, I'm just waiting on new news. I need to see that these aggressive increases in the rates are going to translate into a recession. Good news to me is when we see people suffering. I know that sounds shit and horrible, but like when I see massive foreclosure rates, when I see job claims, when I see employment rate dropping, when I see new jobs in the market dropping, when I see average income on jobs starting to drop, when I see some of that data that's lagged from the wealth effect, when they wiped out basically a third of all wealth in the world has been wiped out, the effects of that are still coming. The layoffs of that are still coming. The point at which people run out of savings and start suffering is still coming. It's a lagged effect. So we will feel the wealth effect of all of what is happening and happened in the last 6 months in the next 6 months. And I think we will bottom out. It's likely. There's also a crazy, and I don't know, because there's also a crazy possibility at the same time that, the Fed kind of plays, hawkish, and then they go dovish and they stimulate everyone. And they drag this out for like 3 years where they go, oh, we're going to raise rates. Oh, we're going to stimulate. Oh, we're going to raise rates. Oh, we're going to stimulate. And the more they stimulate, the more they prolong this pain and recession and they drag it out. I would rather that they restrict, they get inflation under control. There is major pain. We go into a recession. It needs to happen. It's natural. The boom bust cycles that exist in capitalism are necessary to reset things. And then we correct. The stock market is forward thinking. So the minute the pain is the maximum, when everyone is suffering, you look around, there is no positive news, and everyone is feeling the recession, that's when you fucking go long. It's going to be like when we're 40 or 50% down, we're about another 10% from where we are now. I don't know exactly. I'm just throwing numbers out there. It could be tomorrow. Tomorrow could be the pivot point. We see inflation's coming way down, and it could happen. I don't know. We don't have that data yet till tomorrow morning. So stay tuned, guys. What I do know is that right now I'm pivoting and teetering. I'm using my margin to hold shorts. So I have my longs in cash that I'm holding, and then using my margin account, I hold a huge short position. And that's smart because if the market rips up, I have my longs to protect so I don't get margin called. If it rips down, I win big. It protects my longs. I don't get margin called. This is what you use margin for, is to protect your portfolio, to hedge. So if people ask me, what do I do with my margin account? I don't want to go on margin right now. It's like, this is the fucking time to use your margin. Hedge your portfolio. I mean, it would have been great 10% ago, 2 weeks ago, 3 weeks ago, if you put the hedges on. Wait till tomorrow and see. If tomorrow's data is, bad and, it's below, it depends if we're below or above expectations. If we're above expectations, it could be that there's more tightening needed, which is, again, more pain, which is, again, a lot of businesses, the majority of businesses can't survive at 10 and 12% interest. The government can't survive at 10 and 12% interest. Globally, most countries can't survive at that level of interest rate with the current prices where they are. Prices of everything would need to fall dramatically. So, I don't know, I think the debt's too high. Tax rates would have to rise to like 70% to sustain at those interest levels for a long period of time. So we won't have, I don't think we'll have interest rates really high for really long. I think it'll be a short spike up and then a back down. That's what I think it's going to be. I think we're going to play into the first quarter and second quarter of next year as they continue to hike rates. My hope is that they're very, very hawkish. They continue to just slam the interest rate hikes on us, and they get inflation under control. Inflation is much worse for an economy and for the people living in it. It causes more deaths and starvation than war. Like, it's literally going to kill tens of thousands of people. COVID is nothing compared to how many people are going to die as a result, and this is fucked, as a result of the Fed's decisions to print money in 2020, 2021, and the resulting inflation, and now the response that is needed to that inflation problem that they created effectively. Tens of thousands of people will die. Poverty is the number one killer in first world places. So just in general, poverty is the number one killer. So it's painful. We're in for a world of fucking pain to come. It will be okay though, guys. The world isn't ending. Hopefully, there might be a nuclear war. I hope not. I really, really hope that, that... Did you guys see that article? So the US just bought $290 million, a third of $1 billion almost, in anti-radiation medical treatment drugs for their citizens. They're taking this risk. They're taking it. They're like, this is World War III could happen. I mean, and then who cares, right? Like, all of our stock portfolios are gone anyway. My shorts will be the only thing that's left. Hopefully the banks can cover Hopefully they can pay. Hopefully the brokerages can actually pay on the short contracts that I own, right? If that doesn't happen, we have riots in the streets. So I'm sure that the banks will come good. But yeah, man, like, whew, guys, these are dicey times. These are the kind of times we want to live through if you want to come out hard and strong and rich. These are the times that tighten and sculpt and help us become the best men and women that we can be. So in a lot of ways, we should be thankful that we're going through this. Like, it's like you're going, like, easy mode's great. We've had easy mode for like the last half a decade. Almost, the last decade, really. 2012 to 2021 was like, we did have a recession in 2020, but it was so short-lived. We haven't really had a lot of pain in a long time, and we've had a really good run for like the last decade. And so, I think it's good. I think it's good. It teaches us, when the tide goes out, you see who's swimming naked. You see the flippers that are solid. You see the operators who know what they're doing. I like to think that I'm a great operator. I'm still flipping now in this market. I have flips that I've taken on that have continued to drop, and I bought them with enough margin that I'll still, do okay. But yeah, I mean, I'm experiencing some pain too. We're in a massive recession, and it's it'll be okay, guys. It'll be okay. Let me do some more questions for you guys here. Q&A. Hey Dylan, how you doing? Good to see you on. Major pain, like unemployment shooting up. Yes, 100%. We are seeing a lot of unemployment numbers. Interestingly, though, the U.S.'s unemployment numbers, the last few readings have been way more bullish than we expected. The market, there are tons of new jobs. I expect it to be much worse. So we haven't really had any, like, the reason the U.S. currency is one of the reasons the U.S. currency is so strong right now. It went from 122.9, which is the low last year, to almost 140 at the high. That's an 18% increase in the value of the USD relative to the Canadian dollar. That's a huge jump. It's shitty for me, by the way, because I have to do business in the US, and converting from Canadian to US sucks at these rates. But yeah, I mean, I lost my train of thought here, but a lot of it had to do with the fact that the Fed has been so hawkish, and they're trying to protect their currency, as well at the same time, their economy is remaining strong. Now they're manipulating the data a little bit. Unemployment data is played with a bit, I'll be honest. If you go to Shadow Economics and read into how they've changed the way they calculate the data for unemployment. As an example, if you've been looking for a job for more than 3 months, you're not considered unemployed anymore. There's a lot of things like that where they just manipulate the data. It's like you've got millions of people who are actually unemployed looking for work, who they were like, nah, you didn't find a job in like this amount of time. No, you're not even considered unemployed. Anyway, students, seniors, a whole bunch of other problems too. But I don't want to get into that right now in this episode. So yes, I think there is more pain to come. I am currently neutral. I still have real estate holdings I continue to buy. I just, picking up like half a dozen properties in the last couple of months. So I don't want to say ramping up, but opportunities that slide across my desk that make sense, I'm not afraid to buy right now. The numbers are starting to make sense. I know that if I have a long-term horizon, 5 or 10 years from now, all of these buys are significantly undervalued. Same with the NASDAQ right now. Like if you can buy, Facebook at 70% off of its all-time highs. You don't think that Facebook, Instagram, WhatsApp, it's the same company, Meta, and what they're doing with the metaverse, you don't think that's going to have huge value in the next bull run cycle? You don't think there's a potential to make 3, 4, 5 bag returns? If you put $1 million in that, you could have $5 million in value in those shares, right? So this is the opportunities where, 2 years from now, everyone's going to be like, oh, but like there's nothing to buy right now. Like all the properties are overvalued, all the stocks are, we're at all-time highs again. It's like, well, you had the opportunity to buy, it's now. And you're sitting there afraid, shaking in your boots. So there will be a time to start dollar cost averaging in. I think it's prudent advice to start now. If you're at all cash right now, like I know some people watching this right now who are in all cash, you need to open your brokerage account, take 10, 20% of what you have, and start buying the market. We're down 35%. It's a great time to start dollar cost averaging in. Pick the red days, whatever days are big time down days. If tomorrow's a big down day, you get in and you start buying some. Buy. Put a little bit in, 10% at a time. You'll still be tons of cash. You don't have to deploy everything. You could deploy everything and still have margin to short if you wanted to. But I think now is the time to start dollar cost averaging in. The data around every boom bust cycle, if you study it all, you want to start buying at the bottom. And we're getting close to the bottom. It could be a lot worse yet. I don't know. But it could also bounce back. We could have a bear market rally up 20% from here. There's a lot of upside potential as well. And so I think, personally, over a 5 or 10 year period, you cannot go wrong buying right now. So I would start buying a little bit now. I'm slowly decreasing my short positions. Can I predict the future? No. But that's my thesis. What do you think is the best way of finding deals specifically in a recession? Well, the best way to find deals is to go out there and hunt for them. That means throwing out offers like crazy. You know, talking to 10 agents a day, throwing out a couple offers every day, seeing what sticks. In a recession, it's the time where that effort will yield you much higher results than it would in a bull market. In a bull market, you'll call 10 agents, none of the 10 agents will call you back. One will call you back a week later, say the property sold. Now they'll all call you back and say, please put an offer in. I'll just try. So I think there's definitely opportunity, tons of opportunity. And that's what you got to be doing right now is checking those off-market channels, checking on-market channels. Agents have the majority of the relationships to most of the off-market properties. So beyond like Craigslist, Kijiji, Marketplace, you know, all of those lead places, I think on market is a great place to go and just knock doors and talk to agents. A lot of stuff's just sitting right now. You can negotiate some fantastic deals on market. Yeah, 100%. Stickman Finance says, I sold my house and I'm renting for 6 months. I'm hoping to buy a house in the spring market when more inventory is available. I hope inventory is available. Yeah, I mean, the spring is typically when everyone wants to buy. So the best time, seasonally speaking, to buy in Ontario is December and January. December is, historically speaking, a 12% drop from the spring. So all other things considered equal, if the macro, you know, stuff was all flat and we had no change at all in prices, buying a house in December when it's all snowy and dreary and no one's competing against you because it's almost Christmas time and it's dreary, that versus the spring boom when everyone wants to move, because no one wants to move before Christmas, no one wants to move their kids in the middle of a school year. Most of the transactions happen in the summer, in the spring and summer. So in the winter, you get about 12% discount, seasonally speaking. That's just, if you look at the data over the last like 30 years, there's always a dip of about 10% every December. So even if in a flat market, you get a 10% seasonal dip. So imagine now where rates are cranking here in October, cranking again in November, and boom, now you're going into December, the worst month when most agents are taking the time off. They're not focused on their clients and all that. This December and January, I think, are going to be a great time to buy. And I'm very excited about the opportunity. I'll be in Florida this January, and I will be buying in Florida. Coolio, next question. What are my thoughts on whole life? I did that question already. I cherry-picked that question because I saw it pop up, and I was like, you know what, this is timely to talking about interest rates. By the way, if you're watching this, and you're watching the replay, and you enjoyed that insurance rant or any of the rants that I've given you tonight, do me a favor and hit the thumbs up button. That'd be much appreciated. Give me a comment, tell the YouTube algorithm gods that there's some value here. You know, if you really want to go out and just really make my day, go and share this video on your Facebook or your Instagram. Just do an Instagram story and say, shit, I really got some value from this. Check this link out. That'd be cool. Vlad, how you doing? So Vlad says, hey, Mike, what are your thoughts on some very high dividend paying stocks, 6-7% like CIBC, Scotiabank, that supposedly have paid dividends for 150 years straight? Seems attractive. Vlad, you know, I do think it is attractive. I think we're going to see write-down rates for their mortgage products and their lending products increase significantly, especially with unsecured lines of credits. I think that's going to be a large increase over the next little bit. So that's a risk for the bank stocks. Real estate crashing also is a risk. Well, real estate's already crashed a fair bit, but we will see how that will impact their books and people walking away with their new variable mortgages, resetting from, say, they were at 2% to now they're at 6 or something like that. Or lines of credits, they were at 4 or 5, they're now at 10. People aren't going to be able to sustain those. And so from risk management perspective, I think we could see some bad quarters for the banks. Of course, they'll continue to pay dividends over the long term. But why buy the banks at this level when you can buy bonds at 7 or 8%? Like it just yields better than the equity with no downside from here, right? Like if you lock in a bond at 8% and the rates fall to 3%, you can sell your bond for a hefty profit. So yeah, I mean, if we're having the worst year for bonds in 100 years, I can actually see the argument now for having some bonds and some fixed income in your portfolio. I'm more bullish on fixed income in a recession than in a bull market. Just in general, I think it's a good idea. But at the bottom, I do think equities can make sense too. And so I hear that side of the argument. I'm hearing the other people in the background being like, no one's actually here. I'm just like hypothesizing, people listening to me talk. And they're thinking, oh, well, you know, this is the bottom of the market is the time you want to be mostly equities. I mean, this is a rare time where bonds are yielding very well. Typically in a recession, what you'll see is at the bottom of the recession, rates will fall. They will drop rates to stimulate the economy. They will pump money into the economy at the bottom. And that's when As soon as they start pumping money into the economy, the bonds are shit and the equities start to rip. So ideally, you're in bonds now, and as we get to the bottom, you shift from fixed income bonds to 100% equities, and you ride up the next bull run and make 50% of your money, because we're already down 30, 35, some stocks 40, 50, 60, crypto down 60, 70%. The rip back up will be double the rip down. So if there's a 50% down, we should see 70, 80, 90% rip up. That's almost doubling your money. So there's a real opportunity here to double your money in the next 2-3 years. That's huge. If you had $1 million, you double it to $2 million right now. That's awesome. We're in a real opportunity zone here. Chung says, how are the wholesale deals in this market compared to the ones during COVID? I would say in general, a lot of the wholesalers are still expecting prices that are higher than they should be. And a lot of the wholesalers are trying to still make $20, $30, $40, $50, $60,000 fees. And in a bear market, you take fucking $5,000, $10,000 and be thankful. That's how wholesaling was before COVID. These wholesalers weren't greedy as fuck trying to get 50 grand. They were just going for like 5, 10 grand. So that will come back. They will not be able to wholesale their deals. They're still trying to get prices that are too high. A lot of the wholesalers are locking things up at prices that are using comps that are old. Like a comp that, like a house that just sold now is technically old because it sold 60 days ago or 90 days ago. So you gotta adjust another 10% down. If it just sold for 400, that's not a real comp. Even though it just closed on October 1st, you gotta go 400 minus 10%, 360. You gotta be offering 320 on the property. You know what I mean? Like if you're gonna go wholesale and try to, sell this property off. So depends on the property. There are the income producing properties that are really strong in cash flow are holding their value better than the single family home or some of the other less cash flow strong assets. I lost my spot. Oh, wait, I found it again. So provide advice when buying. Be careful. In this market, I think there's a lot better opportunity on market. A lot of people are not buying on market. There's fear in the market, and some people are overpaying with off market stuff. So off market doesn't necessarily mean better than on market. A lot of the stuff I've been buying it's been a mix, but about half on market, half off market. William says, evening Mike, one of my places in Detroit got trashed. I think that we're flying north a couple weekends to repaint the whole place. I was wondering if you had any pointers. Sorry to hear that. First off, it's never fun to deal with tenants and have them destroy places. I hate it. I hate dealing with tenants directly. I don't deal with the tenants directly. I bring someone else in to deal with that. I'm not in a place in my journey where I want to be dealing with that anymore. So for me, I wouldn't fly all the way to Detroit and fix the property up. I would just hire a painter to go in there and deal with it. And the cost of your flight and your tickets and your time, probably not worth it for you to fly all the way to Detroit to fix your property up and pay for accommodations and everything else. Just get it cleaned up. Build it into your margins. If it doesn't cash flow still, close the property out. Take a gain. Or hopefully not a loss. I know the market's tanking a little bit, but might be prudent to sell. Clean it up. Sell it. It's up to you. I mean, each situation is different and individual. There is no one size fits all. William says, I was trying to figure out if I should go after the tenant who is a chemist, I think brother and drug issue. The US is a different ball of wax than Ontario, but it's really difficult to go after dirtbag tenants. Unless they have really good credit, then you can pursue them. You might get lucky. I've not had great luck pursuing tenants. I think once ever I had a tenant after sending me $1,000 after they moved out. They're like, sorry, I crashed the place. So I was like, I'm going to sue you. I threatened, I had a lawyer write a letter up. I didn't go as far as suing, but I was close. And they just sent $1,000, and I was like, whatever. It's like $8,000 in damage. I'll take the $1,000 off you, and whatever. I'm not going to pursue it. So you might, try and pursue and see if you can tarnish their credit, and as a result, cover the painting. But is it worth the effort to fight? Alan says, hey Mike, have you been looking at any businesses non-related to real estate or stocks? Yeah, I'm starting with 2 other people, or merging rather, for an Airbnb arbitrage, rental, and property management business. So if you have properties that you want to rent out and you don't want to deal with another tenant board, you don't want to have to worry about anything, you want me to increase the value of your property 10%, so it's $1 million property, I'll add 6 figures in value to the property by staging it like mint and offering frequent cleanings to keep the property fresher longer. Everything lasts longer when it's being checked on and cleaned. Doing corporate stays and retreats. So if someone has a property in Burlington, Hamilton, KWC, London, in that whole area, anywhere around there, send me a message. I will rent the property from you I'll take care of it. I'll do corporate retreats on it. I will stage it up nice. I will increase the value of the property. We'll go looking from an A unit rent, and I only want A unit rentals. So if it's not an A plus or like a really nice renovated quality property, I don't want it. But if it is really nice, I can take it to the next level and take it A plus. I can increase the value of it. It's there if you ever need to refinance it or appraise it. It'll appraise for more. Anyway, hit me up. I'm looking for arbitrage opportunities. I want to rent your places. So hit me up if you have opportunities to rent. rosehartcapital@gmail.com. Otherwise, if you want me to manage properties for you, my team would be happy to take on listings, and we'll put them on Airbnb for you. We'll do corporate retreat stays, more longer term stays, stuff like that, where we can get the probably, not always, but probably 20 to 50% more than you're going to get in rent, as well as all the benefits of not having to deal with a landlord tenant board, collecting rent. We have a credit card on file, so there's damages. It could be a profit center for us. Everything's covered, right? Where you don't have that with landlord tenant board with a tenant. So I would always pivot to doing a short-term rental. If you rent it to us, then there's no risk for you. If Airbnb is not allowed in your area, we have a workaround for that. So hit me up if you're interested in that and you have a property that you want to do that with. That's a business that I'm interested in exploring. I'm most interested in businesses that are synergetic to my current businesses that I own and my current brand. So that's why I'm investing in this business, because I think it's a business that's going to pay off. It also aligns well to the lifestyle business that I want to build. More to come. I want to share more as soon as I can about the business, but we're still working on paperwork and things, and I want to wait till all the I's are dotted and the T's are crossed. But yeah, I would love to have retreats in Costa Rica, Florida, London, all around Ontario, cottage country. So if you need help to set something up, we will manage it for you. Turnkey, take care of the property. Again, it has to meet our criteria. We're very selective on the type of properties we would rent or the type of properties that we would manage for you. They got to be really nice, like new build, freshly renovated. There's a certain caliber. I don't want to deal with the B, C, D type properties. It's got to be A plus. But if you have that, hit me up. And you want your property to stay A plus, because with tenants, nah. Someone asked about tenant screening tips. No matter what, even if you screen really, really well, you will occasionally have a dirtbag tenant. And so that's just a reality. The landlord tenant board and here in Ontario and just in general, tenants lose their job. We're in a big recession. It's a tough time. But some things that I like to look for when I'm placing a tenant, solid gold, things that have worked for me no matter what. One, ask for financial bank statements. Say, hey, what do you have in savings? Send me all your investments and savings accounts. If they don't have any investments and any savings, shitty tenant. A good tenant will offer up any of their information. Like, here's my spending history the last 90 days, my credit card and bank statements. And you can see how they spend their money. You can tell a quality tenant just by the way that they spend their money. Right there. But another really great thing is, proof of income. You want to verify landlord references. When you do, as a realtor, I can check who actually owns the property. I can ask them questions about when it closed, information about the property that only an owner would know. So you can suss out those fake landlord references, because there's a lot of them lately. Credit score, verify the credit score, very important. For pets, you start with questions like, hey, I love pets. What do you think about dogs and cats? Like, do you love pets? Are you a pet person? And they'd be like, oh yeah, I'm a pet person. Oh, cool. Because I have a big dog. Like, would you be okay if I brought the dog by and said hi? And they'd be like, oh no, I'm anti-pets. That's what you want, right? Always cats, dogs destroy units. That's the worst. You got to suss that stuff out by asking the right questions in the right way. I used to have a 10 commandments. I have to dig it up, but on top of the financial information, the 10 commandments are just solid gold. Another one my grandma used to do, actually, really interesting. She was a landlord back in the day, and one thing she did was she was like, hey, where do you live now? I'm gonna go check out can I come look where you live now? And she said that was like her golden thing, like just go check where they live now. If they live like a scumbag, then they're gonna be a scumbag in your property. And so one of the things I do is ask for a video. I'm like, hey, can you take a video of yourself walking around your current apartment, how it looks? And if they go to the effort to at least clean their place up and make it look really nice, usually a good sign, right? That they're going to take care of your property in the same way that they take care of the current place that they live. People tend to live the same. Another way is look inside their car. I've heard it's a tip. Look inside their car, see if it's messy. Messy car, typically, they live in a messy house. So not that messy really matters. If you have a really rich tenant that's got great income and great credit score and tons of assets and great financial habits, you'll probably be fine. They're a little bit dirty if you don't mind. It depends on the landlord and their preferences, right? And what kind of property you're dealing with. Is it an A property or is it a C property? C property, you might be stuck with only B tenants at the best, because the A plus tenants don't want to live in a C property. So it's dependent. Yeah. just think through the kind of person you'd want to live in this property. Oh, I lost my spot again. Here we go. In Ontario, I'm so scared. So David, if your property is quality, let's do something with Airbnb. I think there's ways you can do VRBO, Airbnb, corporate retreats. Corporate is great, where like, Rogers or CN Rail will send employees to a town. They'll work out a deal where they'll rent your apartment or they'll rent your house for 3 weeks a month. And they just want something fully furnished, really nice for their corporate employees to stay when they're down there. And so you can get really great rates. The places don't get used hard. Everything's guaranteed. If there is any damages, they'll just cover them on the credit card right away, and it can be a profit center. So I'm a big fan of that. I don't really want long-term tenants in my properties. In general, I'm not interested in that business anymore. I don't like long-term tenants and that type of business. If I can avoid that and pivot to a product where I can have a person on a month-to-month basis, that's way better. Rents, inflation's crazy. Rents are mooning 26% up year over year. I want to have that flexibility to have my property vacant on a dime. If I want to have it appraised, boom, it's empty. If I want to have it cleaned, renovated, sold, whatever I want to do, I have full flexibility. And just in general, even over the long term, you'll make more too. So that's a huge win. So it's my personal opinion. Thanks, AB. Appreciate that. There definitely is value. Ken says, did the U.S. border give you trouble if you took tools across to run our property down there? They don't like when Canadians work. Ken, yeah, you got to be careful. If it's your own property, I think it's a little different. Like you say, hey, I'm just, I'm camping and I want to have something to put together my tent and stuff. So I bought a drill or whatever. Like, I don't think they're going to question you if you brought a little bit down. Pro tip though, you could just literally buy tools down there. And then if you don't damage them anyway, you just return them in a 90-day window. So like a Sawzall, you lose the blade maybe because that's a consumable. But the Sawzall itself, if you kept it in good condition, just return it to Home Depot when you're done. If you're just down there for a couple of months. A lot of people do that. It's like a free rental deposit. But anyway, yeah, I think bringing drills and stuff in the truck, like small tools, no big deal. No big deal. I've never had any issues anyway. I did those questions already. Your dollar cost averaging in crypto as well? Not right now, actually. I'm waiting for the bottom to start buying, and I think that I'd like to see another 20-30% pullback, but I still have a considerable portfolio in crypto, enough that I'm comfortable with what I have. But yeah, I think at the bottom I will buy some more crypto for sure. I don't want crypto to ever be more than 10% of my net worth, and so I will rebalance to keep that at that amount. I still love crypto. It's a great asset class. Alan says, with the expected recession, what pointers do you have to pitch deals for JV partners and advice for new investors to start in this market? Well, not even expected recession. Like we're literally, by clinical definition, in a recession. The stock market is down 35%. Over a third of all real estate and stock value is wiped out. Over half of all crypto value was wiped out. We're talking about trillions upon trillions upon trillions of wealth wiped out. Many companies going down, going bankrupt. Layoffs are just beginning. The pain is coming. How do you pitch that? When is the best time to partner up and buy properties? It's now. We're getting into the best time in history. You don't want to be buying at the top of the market when everything's going great. You want there to be massive pain in all directions. You want to look around and see people losing their jobs, stock market's destroyed. That's the time to be partnering up with people. So like, historically speaking, the data suggests this should be the easiest time to raise money with investors. But investors are afraid. So simply cite the data. Like, this is the time when cash flow will be maximized. If they were talking to you 8 months ago or a year ago about partnering, they should be hella interested about partnering now because all the deals are better. The cash flow is stronger, right? If interest rates are high, and that's their fear, right? I got a lot of investors saying, oh, well, nothing cash flows. Rates are going to come back down. If nothing cash flows, it won't last. It won't stay this way. The government isn't cash flowing either. They need to increase their revenue by 30% just to cover their debt. They can't stay in a high inflation environment for long. No one can. So I think things will come back down. And by that, I mean rates will come back down, not necessarily prices. You can only control supply of materials so much. And I think that they won't drop that much. And labor can only drop so much. Again, I don't see I don't see bricklayers coming out and saying, hey, we're going to go below $35 an hour now that we're used to getting $35 an hour. We're going to work for like 22. No, those days are gone. Like people are going to, the cost to build is just higher now. And so that the cost of building does keep real estate at a certain bottom, where like a tech company has an infinite bottom, could go bankrupt, but real estate always has value. There's a bottom to it. That's what I love about real estate so much, is that you can't lose your shirt in real estate. If you're careful about the analysis on the deal and you buy strong cash flowing properties, you don't get wiped out in the same way. So it's a great place to preserve wealth. Over the long term, you make a lot of money with real estate. It's a solid asset class. It holds up better than any other asset class, in my opinion. So I still think real estate is a cornerstone of everyone's portfolio. And if you don't want to invest in individual properties, partner with someone and be a passive partner, or buy a REIT at least. Go out there and buy some REITs that are 20, 30, 40% off right now, and you can invest into real estate and at least have that exposure, that brick and mortar exposure. Vacant property is single family house, but is B- area, so not to your standards for short-term rental. Yeah, unfortunately, probably not. Brandon says, definitely trying times, Mike. I find myself shopping for GIC rates now for 4.5% for 1 year. How times have changed. Any suggestions on dipping into crypto physically or buying Bitcoin or ETF? Literally, if any of you guys are buying GICs right now, holy shit, call me. Like, I can lock you up on properties that have the same risk profile, like 60% loan to value, first secured mortgages with like zero downside risk at this point, that pay 10%. Fixed income opportunities that pay 10% right now. Call me. Call me. Don't call me. Email me. RosehartCapital@gmail.com, or at Mike Rosehart on Instagram or Facebook. Yeah. Don't buy GICs. They are paying better than they've ever paid before, but there are better opportunities out there right now that at similar risk profiles. Okay, I've been through all the questions. I gotta roll this up. Pain don't hurt, says Patrick Swayze. He died, unfortunately. I guess pain got him in the end. That was too much. Roadhouse. We'll kick. That's it. That's it for the stream. All right, spend less, earn more, and maximize returns and the difference, everyone. That's it. 3 levers to control the wealth of your financial future. All right, everyone. Bye. See you next week.